It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and I'll tell you what, we got a lot of stuff to talk about today. I'm sure most of you have been paying attention to this whole GameStop situation. I'm going to tell you, I find it really, really fascinating. And what I mean by that is not so much of the financial aspect of it. Obviously, that is important. That's a key element here. But also the political side of it. I find is quite, well, just fascinating. It's really quite the word, I would say. And, you know, the thing is, I've got a couple articles here that I wanted to kind of bring to your attention. And first one is that I'm going to say this. It really, I'm going to say, kind of brings light to the whole situation and really how it's going to affect our money and the markets and the economy, politically, a lot of different things going forward. And the first one is, it's actually an article that states, I thought it was interesting, was more bubbles, less shorting, what the GameStop craziness could mean for the future of investing. Now, that's kind of interesting because, you know, getting a lot of folks are asking, you know, what do you think this means? What is it going to impact? You know, retirements and investments and the various things like that. And like I said, like this article talks about is, you know, the stock market is known for being unpredictable and volatile, and any sense of normality was blown up during the recent GameStop rally. It's caused a lot of consternation with people because it just kind of illustrates, well, the risk that there is that can happen suddenly out of nowhere, it seems, you know what I'm saying? So, and like I said, again, most people have been paying attention to the story. If you haven't, you know, hedge funds had a bet on the video game retailer losing value, you know, GameStop, of course, and they worked together basically to bring the price and actually increase over 1,500%, which is amazing. That's an incredible amount of money. Or I'm just, yeah, well, yeah, amount of money. And again, it wasn't even so much the amount of money and it was the impact of actually working together. You know, like I said, like this article even says, GameStop rally resembles bubbles of the past, but you know, there's some remarkable, some unique characteristics. See, because of this situation, you know, I've gone to the Reddit pages. I've actually gone back and read all the way back a year or more back, kind of the whole process to get a feel for what it was all about. And, you know, really, it seemed like in the beginning, it was just some people looking at what they thought was a good opportunity, okay, to maybe make some money. And it wasn't really widely accepted for, gosh, nearly a year or so. And when it became apparent that, in public knowledge actually, that the hedge funds had shorted GameStop 140% of the available stock, that's when a bunch of folks started realizing there was an opportunity here and decided if they would buy that stock, basically, it would increase the price, of course, all the buying activity, but then it would also force the shorts to cover. Now, if you're not familiar with shorting stock, you know, basically, simply put, is that somebody's betting that the price of the stock is going to go down, and they sell an option, and they get paid up front, and of course, then they have to buy back the underlying stock at some point in the future. And their idea is, of course, if the price goes down, they can buy it at a lower price and keep the difference, keep the profit. Now, a lot of people have been picking on shorts and hedge funds and things like that because, well, it just kind of seems unseemly to bet against a company. But shorting has a purpose in the markets. So the thing is, I guess what I would say is, you know, when you buy a stock, there has to be a seller, right? So there has to be somebody on the other side of the transaction. So there is a valid purpose, a real necessary purpose, I should say, for shorts, you know, shorting a stock, okay? Now, the thing is, where it gets really unseemly is when they get over aggressive about it. And there's many stories, many stories about, you know, hedge funds particularly are most commonly short stock. They're the most common ones to do it. By the way, the value that they bring to it, not only, there's more to it, and then I'll touch on the over exuberance of it. The value that's brought to the table is, of course, if somebody's going to buy, there needs to be a seller. So it has to be somebody on the other side of the transaction, right? Otherwise, there's no market. There's no stock to buy, right? Or no transactions would occur. Also short sellers, because again, they're betting against the stock. They're betting the stock is going to go down in value. They're looking for things. They serve a value or purpose. They look for things, well, bad news, right? Things that might be happening that would cause that stock to lose value, obviously. And it could be regulatory things. It could be lack of profitability. It could be any number of things. And often short sellers will bring those kinds of things to light. The reality is if everybody was a buyer, there were no sellers, it'd just be over exuberance, exaggerated, if you know what I'm saying. So it brings a balance, a yin and a yang, if you will, to the markets. Okay, so that's where the value is on short sellers. Now, of course, when it gets over exuberant, well, then that's when things get a little distasteful, I guess is probably the best word I can say. And what I mean by that, and this is where a lot of folks have issues, is, we see it. I mean, it's not necessarily, the most, I don't know if the word ethical is the right word here, but it's distasteful. How's that? Maybe where a short seller will sell the stock and then they'll go on the news, CNBC or various places, and they'll talk about all the problems this company has, and in essence, kind of push down or beat down the price with sort of a media blitz, right? And if more and more short sellers get on this bandwagon, so to speak, it can really push or beat down a company's share price. Now, obviously, a short seller, ultimately, the biggest win is if a company goes out of business. Because if a company goes out of business, literally, they don't ever have to buy the underlying stock back, and they keep all the profit that they received in the beginning when they entered into the trade. Now, that has caused, again, some over exuberance and, frankly, has led to some companies that, let's be real, in most cases, were probably struggling to some degree anyway. But it certainly caused what's termed as a death spiral. It was sort of the straw that broke the camel's back. So maybe the short sellers weren't the one that caused the problem, but they certainly didn't help. It's like piling on. And, we as Americans in general, we tend to root for underdogs. And when you've got an underdog and somebody's struggling, it's kind of distasteful to see folks just piling on, if you know what I mean. So that's really where the issue, I guess we might say, comes into play. And the other part of that is, and why it's become so personal, here's the thing about it. It wasn't initially, like if you go to the Reddit pages and stuff, it wasn't initially an effort to get at the man or get at the hedge funds and things like that, although it sort of grew into that kind of a movement. But here's the thing. When companies go out of business, jobs, those are jobs that go away. So like you take GameStop, has something like over 5,000 stores nationwide. And you take a lot of folks who are on Reddit who are, by their own definition are millennials and things like that, in Gen Xers and things like that by their own admission. And many of them have been really hurt about this whole COVID downturn or shutdowns and things like that. Many of them lost their jobs, and many of those types of jobs were service-related or more beginner jobs, let's say GameStop type jobs, right? So, it hit them personally in many ways. So it grew into a movement, not for everybody, but for a lot of people, into, hey, this is a way for us to get back. We've been shut down, we've lost our jobs, and all that. So you can understand the level of frustration that's been experienced here and why people have jumped on board with this so much. The results of it, though, in terms of how this affects our money and such, I think are going to be interesting and far-reaching. Now, how it would affect you personally or your retirement or those kinds of things, I can't really say. Obviously, if you want to discuss this further, I would encourage you to contact us at yourpersonalbank.com. I'd be happy to talk to you about your situation, obviously, how maybe this situation or the economy in general, many of the changes that have been occurring already with many of the president's executive orders. Okay, what's going to happen? Are taxes going to change? A lot of people think taxes are going to go up. Things like that. But my point is, how is this going to affect the markets and the economy and things like that? Again, I think there's going to be some far-reaching results. You know, one of the things is, and a lot of people say, well, why did this happen? Well, let's face it. A lot of people have access to trading today through smartphones, and there's many trading platforms, but actually that have free trades. So it's really made it kind of easy. One of the social sites is famous off Barstool. Their sports betting is kind of their thing, right? They're very sports focused, and you might say like Robinhood and other apps like that, phone apps for trading, have kind of democratized trading. And so there's some positives of that. More people learning about money and investing and putting away funds for their future, things like that. I see that as also another paradigm shift, particularly with the younger folks that just didn't have, frankly, a lot of that knowledge, okay, just so to speak. So there's certainly that too. There's going to be a higher level of knowledge, I think, is what's going on. But like I said, and the other thing, I was going to say, what I lost my train of thought there for a second is, but the realm of, knowledge and knowing what's going on and access to all this information, has been revolutionized with tech and everything else now. It's just not the large Wall Street firms that have access to much of this information. And many times, when a company makes an announcement, for example, or whatever, a lot of times it's put out on social media first now. So everyone has access to the same information in real time, where in the past, obviously it was Wall Street that kind of dominated that, and everybody else found out later, if you know what I'm saying. Certainly gave them an advantage. I think one of the big things that's going to come as a result of this is the power of the group, of the individual, or, banding together. They caused like a $70 billion loss in January for hedge funds. I mean, that's massive. And, of course, hedge funds and Wall Street will adjust for that risk, of course. But at the same time, the average everyday Joe, the average person, has realized there's power in numbers. I don't think that's going to go away anytime soon. Okay? So I don't believe, time will tell, of course, will this GameStop situation be a one-off thing, one-time thing, unicorn event? Or are we going to see more of these types of things in the future? And I think that's more likely, frankly, that we'll see more in the future. So we're gonna stay apprised of this. I've got a few more things to discuss about this and how it affects your money. But as always, I'm going to encourage you to contact us at yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And, well, today we've been talking a lot about the GameStop surge. And, not so much about what actually happened, the specific details. I'm sure you've read about that. Most people have, unless they've been hiding under a rock, they have been paying attention to it or heard about it. I find it fascinating. Like I said, I've been talking a lot about, really more about what are the impacts of this event in terms of our economy, our money, the markets, all those types of things. And I've been referring to an article. It's actually, we'll post it on our website. It's More Bubbles, Less Shorting, what the GameStop craziness could mean for the future of investing. Now, the thing is, that's going to be interesting because, the thing, like this article talks about, obviously the folks, one of the big things I'm going to say is, basically, it's like the first time that a group of folks got together and went up against Wall Street and, frankly, for a while, won. Now, of course, everything happened and changed as a result of it. But the one thing, it's kind of like this. When you've seen something, it's not like you can unsee it. There's been some unsavory things that have happened. But most importantly is the individual has realized by grouping together a bunch of small individuals can have real power. I mean, let's face it. In January, the hedge funds industry lost something like $70 billion as a result of this. So, I mean, this is not small. and it's not weak, if you know what I'm saying. And I do believe we're probably going to see more of this, not less. But here's the thing. Again, well, two things. Well, we'll get to that in a second. What I really want to get at is, like a lot of people are saying, this can make other investors more skittish about shorting because of the increased risk. Because if a group, if a hedge fund is shorting a particular stock or company, let's say, and they get targeted by a group of folks like GameStop, they could be in for some significant losses. So they're going to be more hesitant about that. And actually, less shorting actually means a less healthy market. Like I was saying in the first segment, if you're, whenever you're buying a stock, there has to be a seller to make, there has to be both sides of the transaction to make it work, And like what a lot of folks are saying, particularly with this article, is, bubbles tend to be less common in countries where short sellers are less restricted. See, the short seller's pessimism can balance some of the optimism. Without contrarians, especially with a market that we have now nearing all-time highs typically, let's face it, we need sellers more than ever. So there could end up being, as a result of being less sellers or short sellers or more hesitant short sellers, what they're saying here in this article is we could actually end up having more bubbles and more higher, bigger bubbles, which is, in the big scheme of things, probably not the best thing. And I guess I bring this up because, well, with bubbles and things, a lot of people are concerned about it already where we are. And having some diversification, some safety in your portfolio, it just makes sense. And it's something I've been saying for decades now. Whether the markets are up or down or sideways or whatever, it doesn't really matter because hardly anyone can argue with diversification. I mean, one of the things I tell, that's what your personal bank a lot of times can be a piece for that. Again, when I get a radio listener that contacts me, invariably, the number one reason or the primary reason they'll say is diversification. They'll say, it just makes sense. I don't think nearly anyone would really argue that somebody should have most if not all their assets in the markets, the stock market, for example, or the real estate market, or cryptocurrency, or pick any other asset you want. It doesn't really matter. Diversification is key here. I do talk a lot about safety and guarantees and tax favored growth and things like that. Having a tax-free bucket of money that can grow tax-free, you can access income tax-free, and you pass on to your heirs income tax-free. That's one of the things your personal bank does. The thing is, I can't tell you how many times I've seen this. I'll meet with somebody and they'll have most, if not all of their money in the markets, subject to some sort of risk. Now, there can be varying levels. I get that. But the thing is, and oftentimes I'll see most, if not all of their assets are tied up like in an IRA or 401k, for example. The problem is with that is they now have, of course, they have market risk, but they also have tax liability risk. Another one of the things I say to folks all the time is, can you tell me what the tax rates are going to be when you access the funds? Because, of course, in a traditional IRA or 401k, when you take the money out, you're taxed on 100% of the money because you never pay tax on it, right? You defer it in the beginning. It's the old seed versus the harvest argument. In other words, is it make more sense if everything's equal? Should you pay tax on the seed or the harvest? Well, the answer is it depends. Now, if you think tax rates are lower now and they're going to be higher later, like a lot of folks are saying now, they think tax rates could easily go higher given like the current administration we have, plus all the extra debt that's been taken on by a federal government previously and now added onto through COVID, our tax rate's going to go up. If you think that's a distinct possibility, deferring taxes to the future may not make sense, or may make sense to scale back or adjust accordingly, or like I always say, create a second bucket of money. In other words, create a taxable bucket and a tax-free bucket. I mean, doesn't that just make sense? I mean, if nothing else, irregardless of what happens in tax rates in the future, you have options. In other words, you could choose by creating those two separate buckets, that diversification, if you will. you actually create a situation where you can control to a large degree how much tax you pay when you withdraw those monies. How do you do that, you say? It's quite simple. If you have two buckets, you have a traditional IRA, and once you're, currently the law is once you're 72, the distribution requirements, you have to take a certain amount of money each year out of those traditional IRAs. Many folks take that and then some because they need it to supplement income, retirement, whatever. Well, what if you could choose up to a point how much you take from each bucket? You can actually reduce your overall income tax, your tax impact by doing that. The key is you gain control because you can choose how much you take from the taxable bucket versus the tax-free bucket. Obviously within certain limits, but you can certainly do that. And again, that gains you flexibility. It gives you options. It actually gives you more control back on your money. And the last thing you got to think about is our tax rate's going to be higher in the future than they are now. That's when deferral may not make sense. Now, obviously, that's something that's going to be different for everyone. I can't say listening here if it's the right way to go for you. That can be determined, though, with a simple meeting. Contact me at yourpersonalbank.com. I'd be happy to discuss that with you. Look at your situation and see if creating a second bucket of money that's income tax free, for example, create that diversification to give you those options down the road, if that would make sense. I can tell you it does for a lot of people, but let's see if it makes sense for you. As always, contact us at yourpersonalbank.com for more information. And stay tuned to the next segment because I don't want you to miss this. I'm going to discuss a second article that I think is even the bigger impact, potentially, of this whole GameStop situation in terms of the markets, of the economy, and our retirement. So like I said, you don't want to miss this because this is going to make a big impact on your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And like I said in the previous segments, if you've missed them, I'm really going to encourage you to go back to yourpersonalbank.com and listen to the previously recorded segments and the previous shows. You can listen to any of them. The topics are listed on there. Lots of great information. Listen to it, pass it on to others, any of that type of stuff. But really what we've been talking about today is the GameStop situation, how that's going to affect our economy, the markets, our retirement, those kinds of things. And like I said, this situation have found very fascinating. Again, from a financial standpoint, but a political one too. It really crosses over on both areas. And I think it's going to have some big long-term impacts on our markets, on our economy, and how things go moving forward. I talked about in the previous segments some of the reasons behind why, a group of little guys, if you will, went up against the big guys. It didn't start that way, but it grew into that. And then all the stuff that happened and the shenanigans that frankly happened as a result really put a spotlight. And this is actually the second article I was referring to. We'll put this up on our website. It's by Market Watch, and the title of the article is Robinhood's GameStop Saga Could Put Spotlight on DC and Wall Street Revolving Door. Now, that has actually been a real problem a lot of folks have referred to. It's really sad because the financial services industry, certainly in the leadership areas, the regulatory portions, have been a revolving door. I mean, the head of the SEC and FINRA and all these different groups that are supposedly regulating to protect the consumer are often either former Wall Street heads or soon to be leaders of Wall Street firms. And there's a very cozy relationship there. It's no secret. It's been that way for decades, frankly. But this whole situation has really brought it to light. And like I said, there's been a lot of rules that have been put in place. And what's frustrating, and a lot of people saw this after 08, 09, where the big banks, frankly, got away with a lot, caused a lot of the situation, the financial meltdown, and then basically got bailed out. Okay. And I remember saying back then, even I was as a small business owner and owning a financial agency and all that, I was like, where's my bailout? I never saw one. Of course, we weren't a multi-billion-dollar firm. And so the thing is, it really, it's the unfairness of it. It's the double standard, which has crossed over, from the political sphere for a lot of people into the financial sphere. What's interesting is this whole financial situation, of course, has caused some, strange bedfellows. Money kind of, levels, the playing field, if you will. And folks, whether liberal or conservative or otherwise, when they feel like they've been jerked around with their money, they're on the same page. You know what I'm saying? And I'll give you an example. Some of these trading firms were getting paid, basically for order flow. Like Robinhood, I think the main culprit here, earned more than 190 million in revenue, I believe. Yeah, in the fourth quarter of last year, just in one quarter, 190 million dollars for order flow. Now, what is that? It's basically when somebody places an order for a stock, the Robinhood was giving that information to some of the hedge funds. They were selling it to them. And obviously, that gives the hedge funds, the traders, an advantage. Now, here's the thing. They're not stupid people. Why would they pay a trading app $190 million in a quarter for this information if it wasn't supremely beneficial to them? And regulators had talked about for years about reining that in because it's a very bad look. It's creating two sets of rules. If you're one of the big boys, you can see what everybody else is doing before you do it, or so obviously you have the ability to impact your trades and what you're doing and things like that, where the retail customer, the average person, doesn't have that. So it's an unlevel playing field. Now, they claim to say they don't do it, they don't take advantage of that, but I mean, we're big boys and girls here. Think about that a minute. Why would they pay $190 million in a quarter for that information if it wasn't extremely valuable? So, I mean, it's that type of thing, like I said, that it doesn't add up. I can't sit here and say I know exactly what's going on or what happened or who did what and all this kind of stuff. But when you start seeing these kinds of things, it's one of those things. If you smell smoke, there's probably fire. You know what I mean? So that's kind of the problem or the issue that we see is in the lack of regulatory enforcement, I guess you will, of these big firms and these big players. And of course, they'll come down hard on a little player, a little person. So it's like that double standard, that two sets of rules they're dealing with our money, right? And that's really, really frustrating, deeply frustrating for a lot of people, and myself included. I understand that, and I can understand why these folks are so frustrated. So like I said, stay tuned in the next segment. We're going to go into this further and how it affects you.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we are rounding third and heading home. This is Your Personal Bank Show, and today we've been talking a lot about the GameStop run-up, the aftermath of it, all that's been happening as a result of that, and really the impact, not so much the details of what happened. I think most people have, paid enough attention, know what happened, but more about what's the impact for us, the average person, their retirement, the markets, the economy, and all those kinds of things. And like I said, I think we're going to see some long-term impacts and effects of this. Of course, the little guy basically was able to gather together and go up against the big guy, at least for a while. They pushed back in a lot of ways and showed came to light some of the unfair playing field, if you will. I mean, we always knew that Wall Street had an advantage. I mean, they're professionals for starters, and this is what they do for a living. And an amateur going up against a professional, obviously the professional is going to have an advantage naturally. But the system is rigged more in the favor of the big money folks, the professionals, than many people realized. And a lot of this whole GameStop thing really brought things to light with, Robinhood and such being able to just shut down trading and finding out that really they made their money not from being a trading app, but from selling the information onto trades to several of the hedge fund companies, frankly, to give them a leg up. Again, Robinhood in the fourth quarter of 2020 got paid $190 million for that information, for that trade information. Well, if it didn't benefit, and who bought it? The hedge fund, most primarily. Well, if the hedge funds didn't benefit from that information, why would they pay them that kind of money? That's pretty obvious, okay? But also, it's a lack of regulatory action. It's been pronounced for a while. Wall Street and DC have kind of been a revolving door, particularly in the regulatory environment. So there's been, and this is irregardless of, how should I say, administrations or all that. It's just been kind of a good old boys club, a good old, what I'm saying. And sadly, we've seen it with the big banks. We've seen it with many of the big Wall Street players kind of get away with things with just a slap on the wrist. A lot of the fines that they pay for the way they do business has kind of come to light as a result of this. It's cheaper for them. It's meant to sort of bend the rules and pay the fine, sort of as a cost of doing business. And some of these things probably should just be shut down. I mean, the fact that the hedge funds, the fact that GameStop at one point was shorted at 140% of the available shares. Well, that in and of itself screams to me a big problem. I mean, how can you sell 140% of something? In other words, how can you sell something that doesn't exist? And I've heard explanations. I do have some understanding of how this all kind of works. That share A was sold to this person and then to that person and that person. They're counting all those times. Okay, maybe that's the case. But there certainly should be a limit to a number of times that could be, I don't know. Some way it opens up the opportunity for, for shenanigans. How's that? Fraud, whatever it may be. I'm not saying there definitely was, but it's certainly the appearance isn't good. And the possibility, the potential for it is certainly increased. I mean, I guess somebody could correct me on this, but I'm not aware of that you can buy more than 100% of the available shares of any particular company. I don't think that's possible. Why should you be able to sell more than 100% of the shares? You see what I'm trying to say? It's that kind of stuff. And the regulators have repeatedly talked about curtailing that kind of activity because it does lend itself to fraud or potential fraud. We'll put it that way. Yet it still continues, and that's why this whole GameStop thing. In fact, there was hearings done in 2014 where the recommendation by the regulators was to actually ban it. There were Senate hearings. There were so this is not a new idea, and it's not something that people just recently come to the conclusion is probably something that shouldn't be allowed. Yet it continues to be so. Okay. The thing is, it's these payments too for the information, for the trades that's bothersome. I mean, here's another thing. There's another point, like in this article, like I said, this Market Watch article that we'll post on the website. The thing is, you've got market makers have to pay for some of this information. Well, if they didn't have to pay for it, that could be savings to the investor. So it actually costs people more to trade because of these practices that are in place. And it's kind of weird, like as this article says, it's weird that if you're a retail trader, your order doesn't go to a stock exchange, but that it goes to a broker that gets paid to send it to a market maker. So in other words, it's going through a roundabout manner before it actually gets to where it's supposed to be. Now, obviously, that's not the case for a big Wall Street trader, right? So certainly they have the advantage in terms of time of beating you to a trade or a buy, what I'm saying? So again, it's not a level playing field. Now, I'm not saying that anyone should expect that it was a level playing field. I don't think anybody realistically thought that was the case. But certainly these kinds of things that could be well, construed as, well, like I said, a conflict of interest at the very least, to outright fraud potentially. I think those things should certainly be curtailed, if not banned outright. Let's just make it an open and free market. I could say that's about the election. I've talked about that before. I mean, I'm not saying here that fraud happened. I wasn't there. I can't say firsthand that that's the case. But transparency, I think, is important. And this is where it's the bigger picture of the markets and the economy and where we're going in the future and such. And why diversification outside of the market with some of your money makes so much sense. And like I said, contact me at yourpersonalbank.com if you want more information on that. I'd be happy to talk to you about that. There's When these kinds of things happen, what it does is it creates a lack of, well, confidence, right? If people feel like they were taken advantage of, they're going to be less likely or willing to engage in that activity again, right? So whether it's voting or whether it's investing in the stock market or anything else for that matter, if confidence is shaken or reduced, they're less likely to engage in that behavior. Well, if fewer people are confident in the markets overall, what do you think the big picture is going to look like in terms of market returns? And what are a lot of people, and this could hurt an awful lot of folks, who are counting on this money for retirement or supplementing retirement or various things. See, in my opinion, and like I said, nobody's asked me, but in those kinds of scenarios, again, whether it's an election, whether it's a stock market, or anything else for that matter, more transparency is better than less. I mean, in the technological age that we're in, there's got to be a better way. And there's certainly capabilities when we're talking about trades and the markets and those kinds of things, this GameStop, Robinhood situation, all of it, instead of hiding behind stuff and allowing people to game the system to their advantage, how about let's just be a little more transparent? I mean, let's face it, if they're a big Wall Street firm, don't you think they already have plenty of advantages? My gosh, they have access to the best technology, the brightest minds. They're professionals. This is all they do. It's kind of like, I heard this analogy. It's like you going to play basketball against LeBron James. You might have played in high school or college even, and you might have been pretty good. But I think it's a pretty safe bet if you played one-on-one with somebody like LeBron, he's got some advantages on you, significant. And then if you put on top, I mean, he's already got the advantages. So why does his baskets need to count as 3 and yours count as 2, for example? In other words, he's running with a different set of rules with all the advantages. And that's what we're talking about here. And that's where confidence in the markets and things like that get shaken and are affected. Like I said, there's some good stuff from all this. Better financial literacy. More people talk. It's interesting. There's more people, younger people particularly, talking about the markets and things like that, and money and finances and all that, which is great, than probably at any time I've ever seen. And so there'll be some real financial literacy lessons that'll be learned from all this, which is excellent. I've always said that stuff should be taught. It should be taught in schools. It should be taught, basic financial literacy, unfortunately, is not common. That's why I try to share some of that with this show periodically at different times, because I find it so uncommon. And what I also find interesting on the financial literacy front is, I mean, I wasn't taught this stuff growing up either. I had to learn it, some of it the hard way, some of it through mentors, some of it through experience and various things. But it's interesting. It doesn't seem to matter like the level of education or intelligence of the person I'm dealing with. In fact, I have many clients who are very successful in their fields. Professionals, business owners, various people like that, who have almost no or terrible financial habits and financial literacy. They make tremendously foolish mistakes with their money. I've done it myself in my lifetime. But like I said, learned some of this stuff the hard way growing up and as I matured. Um, it's rampant out there, and it's sad. And that's why, again, I try to share more of that. And why, another reason why I think your personal bank is so important, because one of the things it does is it creates a systematic a system of savings. I have yet to meet somebody who's successful. I'm talking truly successful financially, that frankly didn't and kept it for a long period of time, that didn't have a systematic way of putting money away. In other words, more than they earned over a period of time. And many times before they started the investing and doing the other things. In other words, they built the foundation. That's why a lot of the times I tell people, if you're just starting out on investing, or if you're, whether you're young or old, doesn't matter. If you're just getting started in your financial or restarting in your financial life, start with putting something away each month on a regular, consistent basis. Build a cushion. I mean, one of the things that's taught all the time to people getting out of debt and things like that is the first step is putting some money away. So you got that emergency fund covered, right? Many times I'm talking to the choir here, but a lot of times I'm not. And your personal bank, by setting up a high cash value policy, start building some cash reserves, some funds that are available if and when you need them, and then accessing them from a bank line of credit and creating positive arbitrage. That's what your personal bank does. It allows you to earn interest on money you spend, that you first earn, put away, and then later save or whatever, and then later spend or invest in other things. What it boils down to is you end up with more money to live on because you're still earning interest on money you spent. See, I haven't found another way to accomplish that. And if I did, if somebody has a great idea on how to do that, I'm all ears. But I've been sharing this idea for years now, and I'm on the radio sharing this with people for, everywhere. And I haven't seen it. So my point is, it's a way to put some money away for your future. You have cash reserves. It's a way to do, for emergencies, opportunities. Obviously, that's important. Diversification, those reasons are important. Tax, reducing your future tax liability. All those things are important. So as always, contact me at yourpersonalbank.com. I'll be happy to discuss with how we can change your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.